trend.
Jim Bianco, the floor is yours.
Yeah, the Fed, I'm going to agree with Mohamed El-Erian, who had on this morning. The Fed has lost control of the narrative. You know, we're talking about 50 or 25. What is it that they're trying to do? Are they trying to raise rates to just show that they care about inflation but not really deal with the issue? Or are they intent on saying that a 40-year high in inflation and the number of people that are complaining about it? Remember that according to political polling, the number one issue in the country is inflation. It is not COVID. It is not Russia-Ukraine. It is not climate change or crime. It is inflation. Are they intent on dealing with that? If they are, then they're going to start with 50 and they're going to go and they're going to make it hurt, because that's the only way they can bring inflation down. Because, yes, it is part supply, but it is also part demand. So what is the policy that the Fed's trying to do here? And I'm not sure that they know yet. They seem to want to find one that's going to make inflation come down, the stock market go up, and everybody's happy. Unfortunately, they got to pick one. They're either going to have to deal with inflation, which is where I think ultimately they're going to go and be more aggressive, or they're going to have to say they can't risk growth and let the stock market run back to new highs. And last thought for you, the consumer confidence numbers from Michigan came out today. They were just not good at all. 50% of the people in that survey said they expect their standard of living to fall in the next year because of inflation. So are we going to ignore that are we going to ignore that they're losing on their standard of living because we can't let the stock market have a 10 or 15% correction? So which way does the Fed want to go with this? It's going to be very difficult for them.
They got to pick their poison. We can revisit the credit story in just a moment. Jim, I want to come to you on treasuries. Balance sheet reduction in the mix as well. I'll talk about Mark Cabana of Bank of America a little bit later in the program, but Mark Cabana was talking up $1 trillion of balance sheet reduction this year, $1 trillion again next year. And Jim, my first thought was, OK, if we're going to go 7 hikes in the way that Bank of America thinks we are, and you throw on top $1 trillion of balance sheet reduction this year and next, Jim, what does this yield curve look like?
I think it's going to invert is what it's going to wind up doing, because keep in mind, you can do $1 trillion of balance sheet reduction this year and next year without the Fed selling anything. They could just let bonds mature. They buy about $100 billion a month just to keep the level of the balance sheet the same. So what I think the terminal rate and 7 rate hikes and everything is trying to tell us is that we're probably going to see the yield curve invert by the second half of the year. And that's always been a signal that something is wrong when the yield curve inverts. It's 8 for 8 in predicting recessions over the last 50 years. Now, if it inverts in the middle of the year, the recession could still be 2 years away. It could be even longer away, or it could be 4 months away or so. But I do think that as we go forward with all of these aggressive rate hikes, if the Fed is intent on attacking the inflation problem and with QT that does not require selling, you're going to see the front end of the yield curve continue to move substantially higher, and you'll probably have an inverted yield curve, and that will be your signal that something's wrong, and we probably broke something along the way, and we'll eventually find out what it is.
Jim Bianco, sticking with us alongside. Well, at least there's a trade to make and you're willing to put money in this market, because if we're thinking about Q4 2018 and a repeat of that, Jim Bianco, that's a market I don't want any part of at all. I'll sit that out. Jim, what's the risk of a repeat of what we saw at the back end of 18?
Yeah, I think there is a risk there. You know, just feeding on what Vishu was saying, look, the Fed is the biggest player in a lot of these markets, and they're going to leave. And I've been fond of saying that the bond market will find funding. It will force other markets to fund it by raising interest rates or making those markets unattractive by seeing them increase volatility or falling as well, too. And this is going to be a big problem as we move forward from here. In total, before we started the taper, the Fed was buying $1.5 trillion worth of bonds a year, $120 billion a month. And now if we're going to reduce at $1 trillion a year, or about $84 billion a month, then we're going to have to find $1 trillion from somewhere else in order to fill that hole that the Fed had. And it will be a challenge. It was a challenge in 2018. And it lasted for about 2 weeks, and then we had the famous Powell pivot where he said that the Fed would be patient and flexible, and that ended it. But this time around, with 7.5% inflation, I don't know if we can have another Powell pivot if the markets get messy. So it's the big unknown that we're going to have to jump into.
This sounds like challenging stuff.